Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance.
Buckle up, folks. The Federal Reserve has just recently rocked the stock market with an unexpected move that had investors on the edges of their seats. How dramatic was it? Let's just say, when Jerome Powell makes a declaration, Wall Street listens, and then goes absolutely wild. This last Wednesday, Fed Chair Jerome Powell spearheaded a 50 basis point rate cut, signaling what many hoped would ignite the market. However, even the biggest players like BlackRock and Jefferies found themselves navigating a roller coaster of reactions. Why, you ask? Keep watching to uncover the intricate details and surprising turns that have left experts both anxious and excited. Welcome back, everyone, to Investocracy.
We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
Imagine the scene. Investors glued to their screens, hearts pounding as the Federal Reserve announces an outsized 50 basis point interest rate cut. But instead of champagne popping and confetti falling, what follows is a virtual tumbleweed moment. All three major U.S. market indices, Dow Jones, S&P 500, and NASDAQ Composite, sank by 0.25%, 0.29%, and 0.31% respectively. It's like the market thought it was getting a surprise party, but instead found out it's just tax season, quipped one trader. But why the slump, despite what should have been a market-juicing rate cut? This mystery had experts like Rick Reeder from BlackRock scratching their heads. Reeder pointed out that Fed officials forecasted additional rate cuts, 2 more 25 basis point cuts this year, and another 100 basis points in 2025. According to Reeder, the market has priced in a rate path that looks more like what an impending recession would require, versus the recalibration of rates to a less restrictive or neutral policy evolution, which is what we think this cycle likely represents. But before we go any further, if you want to keep up with the latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates.
Let's bring in Roger Ferguson, former Fed Vice Chairman, as well as a CNBC contributor. Let me just put something to you, Roger, and you tell me if I'm wrong or not. The only way I can figure is that the Fed definitely thinks that one risk in their dual mandate is more important at this point than the other. And it's almost as if they're saying, we feel like mission accomplished with inflation. And then on the other side, they either figure, hey, why not try to keep the labor market really solid, get a lot of Americans working if we don't have to worry about inflation, or they're overly concerned that there will already be a lag in the labor market, and they indeed do see some cracks in the labor market. Which do you think it is?
I think, frankly, it's more the former, if I'm listening closely to what Jay Powell has to say, which is, while they say the risks are balanced, I think you're correct. And, 50 strikes me as acting as though they put a little bit more weight on the unemployment side of things. I do not think yet that they're in panic mode, so I don't think this was an emergency 50. But he said something else that was really important. It was a very strong start, and he very much was clear that, quote, he didn't want to fall behind. So I believe this one is a little bit more in the camp of, okay, we say the risks are balanced, but it's really the labor market that we're looking at. So far, so good, but let's jump ahead of this. And that is, I think, the main issue here is about sort of recalibrating, was to recalibrate so that they weren't, again, falling behind, because they had fallen behind on the other side of this, as you recall, and had to really scramble to get ahead of inflation.
Adding to readers' perspective, Thomas Simons from Jefferies commented that the long-term outlook painted by the Fed wasn't as rosy as investors had anticipated. Simons aptly noted, the long-run rate continues to be revised up, implying a higher terminal rate. The 50 basis point cut today was a dovish surprise, but we do not see signs that more big cuts are coming. Then, there's the speculation that the aggressive rate cut could be the Fed's subtle way of admitting they should have started easing rates months ago. Even Powell hinted as much during his post-FOMC meeting press conference. If we'd have gotten the July jobs report before the meeting, would we have cut? We might well have, he mused. This got investors like Robert Minter thinking, this is a Fed that believes they are behind the curve. Indeed, Fed Chair Powell spent considerable time addressing concerns on Wednesday. He attempted to squash fears about the country's economic health, reassuring reporters that the U.S. economy is in good shape, inflation is down, the labor market is in a strong place. We want to keep it there. That's what we're doing. Adding another layer to the drama, revisions to previous jobs data showed that the U.S. economy employed 818,000 fewer people between March 2023 and March 2024 than originally reported. Robert Frick from Navy Federal Credit Union highlighted that these discrepancies led to doubts about the reliability of labor market data. The half-point cut is an admission the Fed is behind the curve, but not a sign of panic, he opined. So why was Wednesday's trading so volatile? According to Citi Wealth's interim chief investment officer, Stephen Wheating, volatility is par for the course post-Fed announcements. But it wasn't just the decision to slash rates that had investors spinning. Powell also hinted that the near-zero interest rates of yesteryears might be a thing of the past, noting, "It feels to me that the neutral rate is probably significantly higher than it was back then." With this whirlwind of analysis and market reactions, it's clear that the financial world is at a critical juncture. Powell may have laid down a gauntlet, but it's up to investors to interpret that as a sign to brace for turbulence or a golden opportunity to recalibrate their portfolios. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
I think the minutes will show quite a lively discussion, as Chair Powell himself said. I think, recall also there were a number of folks who had wanted to move at the last meeting. So that may have been another group that he had to really think about in terms of, had he not delivered what they wanted, he could have had some dissent on the other side. If he had come in at 25, a few might have descended towards 50. But this was clearly a lively discussion. I wasn't totally surprised. Remember the last time we talked about it, the market and others were saying this is 50-50. So, not shocked, not totally surprised. What I did find interesting was the analysis that he gave for 50 basis points in terms of the economy basically being strong, inflation still somewhat elevated. All of that analysis could have supported 25 basis points. So I think it was not economic analysis that drove 25 versus 50, but rather market expectations and internal committee dynamics.
As economists and market analysts dissect the Fed's monumental 50 basis point rate cut, it becomes evidently clear the time to act is now.
It's time!
While stocks tumbled amidst the initial shockwaves, this recalibration by the Federal Reserve could very well be laying the groundwork for a more stable, albeit cautious, financial future. Considering the projections, the market volatility, and Powell's assertive reassurance, this moment is ripe for investors to make decisive moves. If history is our guide, markets often react negatively in the short term to major Fed announcements, but tend to stabilize and grow as the implications of those decisions become clearer. This might just be a prime buying opportunity, especially in sectors poised to benefit from the recalibration of monetary policy. Savvy investors must weigh the data, the expert opinions, and their own risk tolerance. Now that you're armed with the latest intel from one of the most critical Fed decisions in recent history, what are your thoughts? Are you ready to dive into this dynamic market and capitalize on its potential? Share your opinions and let's navigate these financial waters together. And finally, if you would like to know what the stock market has been up to these past few days, go ahead and click on the next video on your screen.